What's going on, everybody? Welcome back to our series on becoming an Apex trader, the DBT method. This is going to be our 4th episode in a 5-episode series, and today we're going to be talking about volume profile. So as I just said, this is our 4th episode in a 5-part series. We started off with candlesticks, we went into market structure, indicators, now we're doing volume profile, and we're going to close it up with order flow. Before we get started, just a reminder about the giveaway. We're going to be giving away Apex accounts, Addis accounts, Discord access, and a giveaway for a laptop at the end of the series. The laptop is going to be about $3,500. It's going to be a powerhouse to help you guys build a workstation for your trading if you do need one. To get entered in the giveaway, just go ahead and follow what is on your screen right here. Be subscribed to the channel, comment on the videos. You can buy Apex accounts using our code BREW. You can be a Discord member. Just email those receipts to giveaway.dejavutrading@gmail.com. Just take screenshots of your tickets and go ahead and send them on over. All right, before we get started with volume profile, let's do a little recap of what we talked about in our last episode. We talked about moving averages, VWAP, bear flags into VWAP, traps, DBT Momo, the Oasis Trading Suite, and we talked about how you use all these indicators as confluence in your trading. Now, some would obviously say that volume profile is an indicator itself, but it is such an advanced indicator that it needs an entire episode just to cover volume profile. And in today's episode, we're going to be talking about the different profile shapes, the D shape, the capital B, the lowercase b, the capital P, and the trend profile, also known as a thin profile. We're going to talk about forming a trade plan with these profiles and how you can have a bias, whether that's bullish, bearish, or neutral. We're going to talk about the different kinds of profiles, like the extended hours, the real-time hours, like kind of the New York Open, the afternoon, the pre-market, etc. We're going to talk about market profile and what are the differences between market profile and volume profile. And we're going to talk about the types of trades that you can do with volume profile. Before we get started, we obviously have to talk about the basics. What is a POC? What is an LVN? What's the value low, the value high? What are nodes? Building a node. What's the value area? What is shifting value, right? So we're going to get into all these basics. I'm going to do a little bit of a whiteboard session before we get into these other topics. But before we get into that, let's just talk about all the different things we are going to discuss later in the video. So obviously we talked about profile shapes earlier. We're going to get into balanced profiles, the D shapes, the bell curves, the neutral profiles, the imbalanced profiles, the capital P, the lowercase b. Why are they bullish bias? Why are they bearish bias? That sort of thing. What is a double distribution profile, also known as a capital B? What makes them bullish? What makes them bearish? And how can we trade those? What is a trend profile? A thin or one-directional profile, right? And how can we develop a trade plan based on that profile shape? We're going to talk about, obviously, the profiles broken down into different sessions. We can compare the pre-market with the current session. We can compare the morning profile with the afternoon profile. And what is that telling us? How can we make a bias or a trade based on comparing these profiles into each other? We're going to talk about all the differences between a market profile, the poor highs, the poor lows, the single prints. We're going to look at the initial balance, maybe initial balance extensions. And what do I mean when I talk about one time framing? And finally, we're going to close it up with the types of trades, looking into the value retraces, the overnight fade, the value rotations, the sweeps, the failures to rotate. And to close it off, we're going to talk about absorption, because that goes more into our order flow episode that we will close up this series with. All right, so before we get started talking about all these different volume profile concepts, there are a few things I need you guys to understand so that I can explain these more advanced concepts. So let's talk about the basics, right? Let's get into a little bit of a whiteboard here. And let's talk about what is a POC? What is an LVN? What is the VAL, the VAH? What are all these terms I'm going to be using during this video? So when we look at a profile is obviously looking at volume on more of a horizontal scale, kind of against your price axis, instead of a vertical scale that you guys are used to seeing volume displayed, right? Typically, volume is displayed on more of a vertical time basis, comparing how much volume is coming in bar by bar, instead of putting that volume on more of a price basis, a horizontal basis, and building up all that volume on that exact price, telling you how much volume is being traded at each individual price level. Okay, so that is what a profile is in the most basic form. It is showing you volume on that price scale instead of looking at it on a vertical time scale. Okay, so inside of that profile, there are a couple of things. There is the POC, which is known as the point of control. That is where the most volume is traded throughout that entire session, whatever you're looking at. Maybe it is the pre-market session, maybe it's the full session, whatever that session is that you are looking at, the point of control is the most volume inside of that session. From that point, we can build what is known as a value area. Typically, the value area is going to be 70% of the entire volume of that session. Sometimes people like to use 68%, and there's very weird cases of people using like 50% or 40% or some other percentage. The vast majority of volume profile traders are using 70% or 68%. 68% is the more precise, like standard deviation number, but I believe that most volume profile traders actually use 70%. That is what I like to use. So what it does is it builds a value area around that point of control that consists of 70% of the volume of the day. Okay, so that is what is known as value. That is where the value is. And where the value is typically determines how your day can turn into these different shapes. If the value area is towards the top of the day, and there's very little volume or value on the lower part of the day, then it would be a P shape, a capital P, right? If it's on the bottom, it would be a lowercase b. If it had two big nodes, it would be a capital B. And then if it had a bunch of smaller nodes throughout the profile, typically in a one-directional fashion, it would be a thin profile or a trend profile. I'm getting a little bit ahead of myself. We'll come back to these shapes here in a little bit. So going back to it, the highest volume is the point of control. Around that point of control, based on a percentage that the user defines, it creates the value area. Inside of that value area, you obviously have a high and a low. That is a value area high and a value area low. That creates two very important levels that we're going to talk about quite a bit here in the future. Now, what are some other terms you need to understand? Other terms are known as HVNs and LVNs, high volume nodes and low volume nodes. Let's say we have a profile that looks like this, where we have a couple of smaller nodes on the low of day and the middle of the day, and we have a very large node on the high of day towards that upper portion of that day. This would create what is known as high volume nodes and low volume nodes. Now, in between these big nodes, there are obviously smaller nodes because price has to trade in that general area to get from one point to the other, unless there is a gap, which we'll talk about here in a little bit. But if there is not a gap, if price is moving continuously from one node to another node, and it creates a profile that looks like this, then there has to be some smaller nodes in between those two larger nodes. These are known as LVNs, low volume nodes, right? where yes, there is a little bit of a node, but there's not a ton of volume on those nodes. It's not very prominent. But when you have a very large cluster of volume in one price area, remember we are comparing this to price, right? So in one little price area, when you have a large amount of value, a large amount of volume, which by the way, I typically use these terms interchangeably. When I say value, I'm also referring to volume. I don't just mean the actual value area. Sometimes I do mean the exact value area, but I'll explain it further when I actually use that term. So interchangeably, I will say value or volume. When you have low value and low volume, that creates these LVNs. When you have a large cluster of volume, it creates an HVN, a high volume node. Okay. Now, typically when price is moving from one price area to another price area, these nodes will act like magnets, right? The high volume nodes like to act like magnets where price likes to trade in that general area, because we can see that based on the volume profile. It is generating a lot of volume in that area. This is known as acceptance. Price is accepting that area. It is creating a lot of volume in that area. If price is rejecting an area, those are typically LVNs. And remember, I don't mean rejecting in like a bearish sense. I don't mean price is going up and it's rejecting it and going back down. I just mean that price does not like to trade in that general area, whether that means bullishly or bearishly. Price is rejecting that cluster of prices. There is not a lot of volume that is trading in that general area. It is rejecting it. Okay. So LVNs are typically seen as price rejection areas, and HVNs are seen as price acceptance areas. Price likes to trade there. Okay. Whatever your general asset is that you're trading likes to trade there. Okay. So HVNs will act like magnets sometimes, pulling price into them, and they could also act like magnets where price likes to rotate. Rotating is a fancy word for ranging, basically. Ranging from one side to the other. Basically, think about if this node was a range. We take the low of that node and the high of that node. A rotation would be moving from one side of that node to the other side of that node. Okay? Just a fancy word for ranging, basically. So price likes to rotate sometimes on these HVNs. They act like magnets again, right? It pulls it into it. And on the LVNs, if you guys have watched my other videos in this series, we've talked a lot about wicks and sweeps, right? If you think about an area of rejection, that is typically where you're going to see a lot of sweeps, a lot of wicks, because price does not want to hang out in that area. It's either going to very quickly break through it, or it's going to hit it and wick off of it. It's not going to hit it and build it up. Now, yes, we can't always predict exactly what the market's going to do. So sometimes it will do this. It's called filling in a node, right? Building up a node. So sometimes it will range inside of an LVN to build that node up to kind of balance out the day. Like I said, I'm getting ahead of myself. We'll get into this a little bit later. So sometimes it will build that LVN up to correct it into a high volume node, an HVN. But that is not as likely from what I've seen in my trading. More likely is when price rejects that LVN, either bouncing away from it, creating a sweep or a trap, or just one directionally breaking through it back into the next high volume node or the next value area. Okay? So that is what I mean by nodes and building up a node. Building a node is, once again, ranging or rotating and generating value in that area. Because imagine if we came down to test this node here, how do we build that node up? Remember, the volume profile is just showing you where the volume is trading on each individual price. So for us to build this node, we would just have to hang out in that general price and have a lot of volume while we are doing that, and it will build that node into a bigger node. Okay? So another thing you guys have to understand is shifting value. So if we have a balanced bell curve where our POC is towards the middle, our value high is up here, our value low is down here, this is what's known as a balanced profile, a D shape. It looks like the letter D. So how do we shift value from a D shape into a capital P or a lowercase b or one of these other profile shapes? Well, once again, think about what this is showing you. It is showing you that a large amount of that volume is trading towards the middle, and it's falling off in volume as it approaches higher prices, and it is falling off in volume as it is approaching lower prices. They are accepting this middle price, they are rejecting higher value, and they are rejecting lower value. That is why these are typically seen during ranging markets, because the higher price is being rejected, pushing you back down. The lower price is being rejected and pushing you back up. So therefore, where are you trading most of your volume? Most of your volume is trading in the middle. That is what creates a bell curve. Like I said, falls off, but you have a lot in the middle. So how do we generate these other shapes? Let's say we're going from a D shape into more of a P shape. Think about what has to happen for this to happen. You have to find and accept higher value. So think about where our value high would be right here. We would have to break that value high and start to generate higher value. We would have to trade a lot of volume above that value high. So instead of falling off in volume, we are actually gaining volume. So think about a normal D shape, right? Let's say we break that value high and we accept, we do not reject. We accept this higher price. Therefore, we generate a ton of volume up here, which generates a node above that value high. If that node is so strong that it is stronger than the D shape, it is stronger than the node that created the D shape, we will begin to shift all of our value to that upper portion of that day. So let's think about, we started out as a D shape, then we pushed up, prices went higher, and we generated a ton of volume on that breakout. A very one-directional breakout day, right? We broke out, and then we started to find that higher value. Think about that original D shape. Maybe in the grand scheme of things, this is that D shape, where it's a very small node compared to our new value that we are finding on that high now. That would turn into a P-shaped profile. Okay? So let's start talking about all the different shapes and the bias they would give you based on that shape showing itself in the market, right? In that current session, whatever type of session you are looking at. So the different shapes that we have are obviously the one that we just covered, that D shape, the bell curve, very common on neutral days, right? Choppy days. We have the capital P, very common in a bullish imbalance. We have a lowercase b, very common in a bearish imbalance. We have a capital B, a double distribution where you have two bell curves. And then finally, we have a thin profile where it has a lot of nodes throughout that profile. Very common in a one-directional day, either trending bearishly or trending bullishly. So with all of these shapes, how do we create a bias when we see these forming on our trade day? Typically, when you see a D shape, your bias is neutral. It is almost always a two-directional market where not one side is in control It's just going back and forth. They have tried for higher value. They didn't like it. They tried for lower value. They didn't like it. So they are accepting the middle value. They are not accepting higher value. They are not accepting lower value. And I'm going to get into how you can trade these days here in a second. But let's first go over the bias, right? So that would be more of a neutral bias. A capital P, also known as a shorts covering rally, if you guys read James Dalton's books. The book that I really recommend is Mind Over Markets. He talks about this is not a very bullish bias day where the buyers are in complete control. It's more so a bullish bias day because the bears are weakening. The sellers are getting very weak and they're closing their positions. So you have a little bit of buy pressure, but it's mostly from the sellers getting scared and closing their trade. So typically these days have bullish imbalances because value went up and it accepted that higher value, and you have a very low volume lower tail, which, by the way, tails are just that smaller section that is not the value area, right? So typically like above the value area, when you have that LVN, it is a upper tail. That smaller section on the bottom is a lower tail. It's that long portion of low volume that is typically seen on like the upper wick or the lower wick. It's almost interchangeable with wicks, but not exactly. And I'll show you guys some exact examples here in a little bit. But a capital P profile has a long lower tail, very long LVN zone below the value area, and the value area is towards the high of day. And typically with a standard capital P shape, you started down here in the day and you are ending up here in the day. So you started at the low and you pushed up, and then you started to kind of range and build up that upper volume node, typically seen on like bull flags, right? Now this should not be mistaken when you are starting up here and then building up the node and then failing downward. That is known as a D-shape failure. So for example, if you think about a D shape, if you think about a neutral day where we're kind of ranging back and forth, back and forth, back and forth, what happens in a D-shaped profile if towards the end of the day you start to build that lower tail? It finally begins to accept those lower prices. Well, it would look like a P shape, right? Because we would start out with a neutral value area, very two-directional value area, but towards the end of the day, we would accept those lower prices. So therefore, we would build up the lower tail, and we would have a very large value area towards the high of day. So think about on a P-shaped profile, if we started up here, and we chop, 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 and then push down and created that P-shaped profile. Now that would not be a proper P-shaped profile, because it started out as a D shape and then it turned into a P shape. That is what's known as a D shape failure. Okay. So a proper P shape starts with the tail, pushes up, then it finds that value on more of a secondary market. Okay. Once again, it is not overly bullish. It just means the bears are getting weak. The same can be said for a lowercase b. It is a bearish bias, but it's not an overly bearish bias. It means that the longs are closing. The buyers are closing. They are getting scared. They are getting weak. They're taking profit, whatever the case is, right? The bears are in control, but it's not overly bearish. Remember, if it was overly bearish, what would we look like? It would look more like a one-directional trend, right? It would be pushing aggressively in one direction, either to the upside or to the downside. That would be overly biased on one side. The buyers are in control or the sellers are in control. But on a capital P or a lowercase b, you create this large chunk of value instead of trading very aggressively in one direction. So therefore, you have a small bias, but you don't have an extremely large bias. Okay? So a capital P, that small bias would be bullish. In a lowercase b, that small bias would be bearish. The longs are closing, but the bears are not entirely in control. Okay. The next type of day is a capital B profile, also known as a double distribution profile. Think about what a D-shaped profile is showing you. It is showing you a two-directional market where the sellers are in control towards the high, the buyers are in control towards the low, right? So as you approach that value high, the sellers take over, the buyers get weak, you go right back down. Then you approach the value low, the buyers take over, the sellers get weak, and you go back up. We're going to talk about how to trade these here in a little bit. So the bias is kind of two-directional. It's very neutral. That is basically the same case on a capital B, but instead of having one D shape, you have two. Now, typically with a double distribution, the thing you want to look for is where did we start and where are we currently? Which one of these nodes was the first node, the primary node, and which one of these nodes is the secondary node, the node that is more recent? If we think about this being the first node, the node that started the day, and this being the second node, the more recent node, what would that imply? That would imply that value started building here, and then the sellers took over, and now value is building down here. That implies that there was a sell-off somewhere in that day. Okay? Now let's take a look at it the other way. What happens if we started down here, and now we are up here? That would imply that we are ranging here. Somewhere in the middle of the day, there was a push-up. The buyers took control, and now we are ranging up here. Okay? So wherever your secondary node is, if price is obviously still respecting that node, that is who is in control of the day. If your secondary node is towards the high, then the buyers are more in control. If the secondary node is towards the low, then the sellers are in control. Now, there is a little bit more nuance to this, because as we talked about earlier, there are HVNs and there are LVNs, high volume nodes and low volume nodes. And with a capital B, there are typically two high volume nodes, one obviously towards the high, one obviously towards the low. But what happens in the middle? In the middle, it is typically an LVN, a low volume node. If it wasn't a low volume node, what would it look like? Well, imagine if there was a lot of volume here, it would look like a bell curve, because there would be a lot of volume on the high with the upper node, there'd be a lot of volume on the low with the lower node, and there'd be a lot of volume in the middle with the middle node. Then it would not be a double distribution. It would be a bell curve. Okay? So for it to be a capital B, you need the two D-shaped nodes, and you need the LVN in the middle, the low volume node in the middle. Now, typically this LVN will almost always consist of single prints, which we'll get into what those are here in a little bit. But they don't have to be single prints. They could be just a normal LVN, where they are trading volume, but it's just very low volume compared to the two very large nodes. Now, what I like to say about a capital B is not only do you want to look for where that secondary node is to figure out who is in control, you want to see how price is reacting to that LVN zone. Let's think about this, for example. Let's think about we started up here, so that's our first node. Then we are trading down here, that's our second node. And then price is doing something like this, where it's bouncing, trying to go back into that upper node. Because remember what I said earlier. These very large nodes act like magnets. They like to pull price back into them. So if we have two magnets constantly pulling price one way and the other, who is in control? Who has more power? So if we think about this upper node trying to act like a magnet and pulling price back to that upper node, if we are a seller, what do we want to see? We want to see that LVN in the middle act like a rejection zone. Because like I said earlier, LVNs are typically seen as rejection zones. Price likes to hit them and reject, either reject going back into the opposing direction or push through them very aggressively, going into the direction that the market was already moving, the prevailing trend direction. Okay? So if we are a seller and we are trying to trade that lower node, we want to see the sellers taking control of the middle of that day, that LVN zone. We want to see that rejection back down into the secondary node. We don't want to see it rejecting bullishly back to that upper node. Now, obviously, if we were a buyer, that is what we would want to see. So when we have these capital B days, we want to pay very close attention to how price is reacting on that middle, that LVN, and we want to see how price is either rejecting it or accepting it, okay? And that will give us our bias. So we get our bias from where the secondary node is, but also how price is responding to the middle of the day, okay? So there is no easy way to look at a capital B and say it's going to be a bullish bias or it's going to be a bearish bias. All right? We have to see who controls the middle. And finally, we have the trend profile, also known as a thin profile, because typically the thin profile does not have very large nodes on the high of day or low of day. It has a bunch of smaller nodes throughout the entire day. Think about why that is happening. Why would we build up a bunch of smaller nodes over and over and over again? Well, it would be because we're trending in one direction. We are not hanging out and building up these nodes at one price. We start to like a price, and then the buyers come in and push us up. We start to like a price again, buyers come in and push us up, right? And we just continuously do this. Think about those trading days that are so one-directional that you're like sitting there and you're like, okay, I want to trade, but I'm just not getting any pullbacks. I just can't find a pullback to get in this market. Think about what we talked about in the market structure video with the aggressive markets, the very one-directional markets. That is what's happening on this thin profile, this trend profile. It is so one-directional that price is not pulling back or hanging out at any of these single nodes, so you're just forming new nodes. Okay? All right, so that is all of our day shapes and how we get a bias from those day shapes. Now let's talk about how we can determine the bias that we want to trade, right? How can we trade these day shapes? And what are the types of trades that we can look for on these day shapes? And we'll get into some more exact examples here in a little bit. So with a D shape, how do we trade this? What trades do we look for? Typically, a D shape is a very standard bell curve, right? Where the volume falls off towards the high, the volume falls off towards the low, and you have VWAP kind of chopping around the middle where the POC is in the middle, right? Sometimes the POC will be a bit imbalanced where the POC will be towards the value high or the POC will be towards the value low, but normally it's pretty much a bell curve, right? So when we're trading and we understand this market, we understand what is happening in this market. It's ranging back and forth, right? The breakout traders are failing to find higher value. The breakout traders are failing to find lower value. We want to be a seller around the value high and a buyer around the value low. Think about a very standard range that you want to trade, right? You obviously want to be a seller around the high of the range and a buyer around the low of the range. Just put volume profile on top of that range, and there you go. That's what you're doing. The value area high is basically the high of the range. The value area low is basically the low of the range, obviously with very small tails. Outside of the value area high is the upper tail, and outside of the value area low is the lower tail. So obviously we have these tails that are tradable as well if we don't want to be a trader on the exact value area high or the exact value area low. That is perfectly fine. But in the general area of the value area high, we want to be a seller. In the general area of the value area low, we want to be a buyer. Because like I said, the breakout traders are failing to find lower value, and the breakout traders are failing to find upper value. The breakout traders are just continuously failing. It is more of a mean reversion type of day, so we want to go towards that mean, right? We want to look for trades that reverse back into that mean. Now, these trades can be many different things, right? All volume profile is giving us is a roadmap. It is giving us a trade plan, a bias. It's not giving us the exact trigger on why we want to take our trade. So basically think about, I want to be a seller around the value area high, right? We draw a zone. Remember we talked about do not care zones and when we want to pay attention? Well, in a D-shaped profile, you obviously want to pay attention around that value low and that value high. You don't really want to pay attention too much in the choppiness in the middle because it's more of a 50-50 zone in the middle, okay? So when we are paying attention in, let's say, the value area high, we're going to be looking for bearish sweeps. We're going to be looking for top pivots on the Momo. We're going to be looking for gold shading. We're going to be looking for sweeps on the high. We're going to be looking for rollover tops, etc., right? All of those different playbook trades that I teach for top reversals, we are going to be looking for those towards that value area high and that upper tail because we want to be a seller looking for the pullback back into the POC and VWAP and possibly the value area low. Okay, so we want to be a seller up here around that value area high. Where do we want to take profit? Like I just said, we want to take profit around that POC, and typically VWAP is going to be somewhere around the middle. And then we could also look for a full rotation. A rotation is a price movement from one side of the value area to the other, remember, right? So we have that movement from the value high back to the value low. That is a downward rotation. And the movement from the value low to the value high is an upper rotation, okay? So we want to be looking for that rotation for our take profit. We can take profit in the middle around the POC and VWAP, or we can look for the full rotation into that value area low when we start to turn into a buyer, okay? So when we turn into a buyer, same thing. We want to be looking for those bullish trades down here, the rollover bottoms, the bullish sweeps, the bullish divergence, the absorption, right? We'll talk about that in the Delta video. Looking for the blue pivots, the purple shading, etc., etc. The volume profile is not telling us exactly how to trade. It's just giving us a roadmap, a bias, right? It's telling us when to pay attention. So we're paying attention, looking for buys around that value area low. We are going to be a seller, basically a take profit, not selling to open, right? We're going to be a seller around that POC or where that VWAP is to take profit from our buy. And then same thing on the value high. We're going to look for those sell trades to close our buy and then maybe possibly reopen a short. All right. So that is what we would be looking for on a D-shaped day. Where do we want to put our stop loss? Our stop loss, if possible, we want to put our stop loss above the high of day, obviously for a short, or below the low of day. So above the upper tail or below the lower tail, if possible. What do I mean by if possible? Before in the series, we talked about having these optimal trades, having a proper risk to reward. Now, typically on D-shaped days, we want at least a 1 1/4 or a 1 1/2 to the middle of the day, because getting that middle of the day, getting VWAP, getting the POC should be very high probability. So we want at least a 1 1/4 to 1 1/2. I would give you a 1-to-1 on some D-shaped days. Like if it's a perfect D-shaped day, you could be looking for a 1-to-1 risk to reward as well. But typically we want 1 1/4 to 1 1/2. So every dollar we're risking, I want to make $1.25 or $1.50. All right. To the middle of the day, to VWAP, to the POC. If we can get 1 1/2 to more, maybe a 2.0 or higher on the full rotation, that would be great as well. Okay. So where we trade inside that value area high area or that value area low area needs to provide us with that risk to reward. Okay. So if I enter here knowing my stop loss should be below the lower tail, then I can get a 1 1/4 to 1 1/2 on that middle and possibly higher if I'm targeting that upper area. I want to get like a 1 1/2 to a 2.0, maybe more. Okay. Now, sometimes you're not going to be able to put your stop loss above the upper tail or below the lower tail. Sometimes those tails are very long and it just doesn't make sense to where you should be trading near that value area high and where that tail is. Let's say this is like a 10-point move on that upper tail. We're not going to be able to sell that value high and then put our stop loss up here and then target the middle. It just doesn't make sense for the risk to reward. Okay. So sometimes I would say, yes, you can put your stop loss inside of that tail. So below the high of day or above the the low of day. But very often you really want your stop loss to be above the high of day or below the low of day. So more often than not, you really want to manage your entry to where that makes sense. Okay. So inside of that zone, that optimal entry allows your stop loss to be above the upper tail, targeting the middle of the day or the full rotation with at least a 1 1/4 to 1 1/2 or more, then you can do it. Okay. Now, one more thing I want to say before we get into the other shapes is when you are trading a D-shaped profile, you really need to accept the fact that you are trading a choppy, neutral type of market, and you really do not want to be cherry-picking your entries. What do I mean by that? What I mean is when you accept that you are going to be a trader on this day, you need to trade pretty much every single rotation that the market is giving you. So when the price moves into that value high and gives you a sell signal, you take it. It goes to value low, gives you a buy signal, you take it. You can't just cherry pick when you're going to take these trades because you're always fearful for it breaking out, right? You're always like, I don't really know. I don't want to be a seller here because it went up so fast, it might break out here. Or it went down so fast, it might break out to the downside here. You need to accept very early on that you are going to be a rotational trader and you are not going to be looking for breakouts. The reason I say that is because a lot of times people start to cherry pick these rotations and then they start to pick the ones that actually turn into breakouts, and now they just start to lose money. During these D-shaped rotational days, it's really up to the current market. So you have to kind of look at the recent D-shaped days and see how many rotations it gave you before it broke out. But what I will say is normally it will give you anywhere from like 2 to 4 rotations before attempting a major breakout. You'll get a rotation up, a rotation down, a rotation up, a rotation down. That's 4 rotations, right? Then it goes for a major breakout attempt. Now, whether or not that breakout turns into an actual breakout where you hold that value and you're continuing to shift from a D shape into a capital P or a lowercase b or whatever it may be, whether that turns into an actual shift in value or not, that doesn't matter. Typically, every 2 to 4 rotations, it goes for a break to see if it can find that higher or lower value. Some days you have a very solid rotation. It just rotates the entire day. It will do it 10, 20 times sometimes a ridiculous amount. Now, those types of days are sometimes found on micro pullback days. What do I mean by micro pullback? I mean the day prior to the bell curve was very one-directional. It had a very aggressive candle to the upside or a very aggressive candle to the downside. The day after that turns into a bell curve, a D-shaped day, either hovering towards the top or hovering towards the bottom, if it was a bearish day, right? Now think about what that would look like. You would have a very strong impulsive day, a thin profile, building up. Sometimes it would have a P shape, right? You build that upper node. And the following day would be a D-shaped profile, just building up that node that we had from the prior day. This is known as a micro pullback. During a micro pullback, it is very common to see a D-shaped bell curve rotate the entire day. Every attempt to break above the value high fails. Break below the value low fails, right? Those are the type of days you can look for a lot of rotations, where the day prior was very one-directional, either to the upside or downside, and now we have a D-shaped day. Okay? So that is how I would trade a D shape. Now let's talk about how you would trade a capital P shape. Okay, so now we know how to trade D shapes. This is how I would trade a P shape. P shapes are typically when you have a impulse move up and then you find a value, a price that you like. And it starts to build up a choppy kind of D-shaped bell curve on the high of that day. The lower portion of the day is very low volume, creating that long lower tail. There is basically no upper tail because the POC and value area is towards the high of day. So it creates a long lower tail, no upper tail, and a large node towards the high. Now remember, this is a proper P shape where the price started down here, then created the tail, then created the upper node. A D-shaped failure looks like a capital P because it starts up here, chops around, and then sells off, which creates that lower tail. That is not a proper P shape, okay? So in a proper P shape, how do we trade this? Well, we know it has a small bullish bias. Remember, it's only a small bullish bias. It's not an overly bullish bias like a trend day. It is more of the bears are weak, the bears are closing, not the buyers are in full control. Okay? So go into this day expecting a small bullish bias, which means we want to focus on being a buyer mainly around the value area low. Sorry, that said value area high earlier. It's supposed to say value area low. So we want to focus being a buyer around that value area low, not really selling the value area high. We can, remember, it's a small bullish bias, not an overly bullish bias. So you can sell the value area high if you see the right patterns forming. Because remember, it is kind of ranging here to build that upper node. But because we have that small bullish bias, more often than not, they want to break out and extend that upper tail. This can create breakout opportunities known as tail extensions. So we can be a mean reversion trader, a pullback buyer, right? Buying around that value area low, looking for our buy patterns like the pivots, the combo signals, the rollover bottoms, etc., the bullish sweeps, right? We can look for all of our buy trades around that value area low, and we can aim for that value high as a potential take profit, and we can aim for the POC or the VWAP generally in that area as a take profit as well. Or we could look to be a breakout buyer for a tail extension. So how do we determine a tail extension? Think about a capital P shape. What does it have? It has a long lower tail. It has a choppy high volume node, but it does not have a long upper tail. The upper tail is basically not there. It's very weak. So what we can do is we can measure the lower tail. Let's say this lower tail is 20 points long. We measure it from the value area low all the way down to the low of day. That is the lower tail, right? From value area to low of day. Let's say it's 20 points. So if we were to get the same range on the upper tail, we measure 20 points, right? So we measure from the value area high. We don't care about if there's like a small tail that's already there. We don't care about that. We measure from the value area high up 20 points. Because that would be basically an identical tail, right? So we take the 20-point lower tail, we copy it to the upper tail. So think about doing something like this. We just measure it out. We take that to the upper tail and we say, okay, if it wants to extend the upper tail, this is about where it wants to go. And now remember, these are not exact. It's just a general area. So if it wants to be relatively the same size as the lower tail, it wants to go somewhere around here. So we could draw out a zone and say, hey, if I want to be a breakout buyer, if we start to hold that value area high as support, which would be a failure to rotate. Remember, what is a rotation? A rotation is a movement from a value area high to a value area low or vice versa. So what is a failure to rotate? It is not doing that, right? We were supposed to go down. We were supposed to rotate back down to that value area low, but we found too much buy pressure on that value high, and instead of using it as resistance, we used it as support. Therefore, what are we doing? We are looking for higher value. This was our original value. We liked the value around that POC, right? Where that value area was. But now we want to find higher value. So we failed to rotate. The buyers are in control. The buyers are showing that bullish imbalance. And we are looking for higher value. Now, obviously, we could target many things. We could target prior value levels. We could target VWAPs above or high of days above, whatever it may be. But if you were just solely picking your target based on volume profile, you could also target the upper tail extension. We could measure the lower tail, as I just said, 20 points, right? We could take that out to the upper tail and say, okay, if it wants to be relatively the same size as our lower tail, it would be about this general area. So we could target that for a breakout. Now, if possible, we would like our stop loss if we were a breakout buyer somewhere in that general area. We would like our stop loss to be below the POC or below VWAP, or even better, below the value area high. Now, as always, we want to look for a 1.25 to 1.5 risk reward, possibly a 2.0 risk reward, getting $2 for every dollar I'm risking. So if you can manage that, then manage that, right? That's where you want to put your optimal buy. Now, personally, I am not a breakout trader. Personally, I am more of a reversal trader. That doesn't mean that I can't trade a P-shaped breakout into that upper tail extension. I would just have to trade it a little bit differently. Now, if I want to look for that breakout because I am a reversal trader, I really want to be a buyer around that value area low because I don't want to buy basically the high of day. That's more of a breakout buy. If I missed my value area low buy or I already closed it on the POC and the value area high, what I would look for is what I call a rebound trade. It's kind of like a pullback trade. So let's say I was in a trade down here. I took a sweep down here and I closed it on the value area high. And now I'm like, oh, this kind of looks like it wants to break out and go for an upper tail extension. I need to look for another buy. I want to look for what I call a rebound. So let's say we have a strong break of that value area high. We're building up a ton of value on that upper tail. That upper tail originally was very low value. It just fell off a cliff. Basically found no buyers above the value area high. But now we are finding a ton of value above the value area high. There are two things I always look for when we are breaking out of value, when we are breaking out of balance. Balance is just ranging inside the value area, right? The two things I always look for are finding value and protecting that value. What do I mean by finding value? What do I mean by protecting value? If we are breaking out of the value area high, we need to immediately start to find higher value. We need to build up that value area. We need to build up that value outside of the value area high, obviously above it, inside of the upper tail. That's the first thing we would have to do. We would have to find value outside of value, accepting higher value, right? The second thing is we would need to protect that value. How do we know if it's protecting that value? Think about what I just said about balancing and rotating. When we are building up a bell curve, when we are building up any node, it doesn't have to be a D-shaped day. I'm just talking about building up any node on any day. That could be a node on a lowercase b. That could be a node on a capital P. That could be a node on a capital B. It does not matter. I am talking about building up that node. How do we build that node? Price has to accept that node. It has to range and constantly trade inside of that area. That is what builds a node up, because go all the way back to what I said at the start of this video. Volume profile is looking at volume on a horizontal price scale, not a vertical time scale. So how we build that node up is we are respecting that price. We are continuously finding volume on that price, in that general price area. We are rotating in that general price area. That is what creates that node. So how do we know if it's protecting that node and it wants to go even higher? Well, go back to what I just said. So building up a node is doing what? It's going back and forth, back and forth. We're building it up. They're trying to go higher. It rejects it. It goes back down. We're trying to go lower. It rejects it. It goes back up. If we want to go higher, what does that mean? It means that they should no longer be rejecting this price and going back down. They should be accepting that price. So where that node is building up, they need to stop finding a lot of sellers on that upper half of that node, like towards the middle or even towards the high, right? It could be anywhere in that upper half of that node. They need to stop finding sell pressure and they need to start finding buy pressure, because it's going against what they quote unquote should be doing. they should be rotating back downward. But they are not doing that because the buyers are too strong. The buyers keep buying up this price on the upper half of that node. Therefore, they are telling you, hey, we accept this node. We are protecting this node. We do not want to go towards the lower portion of that node. We no longer accept that lower price. We want higher prices. That is what I call protecting a node. So they are finding value and they are protecting that value. So they broke out of their original value. They found higher value. That's the first thing, right? Then instead of constantly rotating that node, they start to push higher. They start to accept that higher value, either on the really high end of that node or towards the middle of that node, and they start to really push it in one direction. Okay? So that is what you want to look for a breakout. Then, in my case, like I said, I'm more of a reversal trader. So I want to see that on kind of a pullback, on a rebound back into that value area high. So if I missed that initial reversal kind of around the value area low, I want to find that reversal on the value area high, meaning reversing back into the buy side. The buyers are continuously protecting that value high, maybe a sweep, maybe a rollover bottom, whatever. Any of our reversal bullish trades, we want to look for them now around the value area high because we found that higher value. Okay? So it starts to accept this price bullishly, then we can look for that trade into that tail extension or into prior value. All right? So we have a small bullish bias. It's not an overly bullish bias, so we want to focus on being a buyer around the value area low. We can be a seller around the value area high, but we need to be very careful. If we are selling the value area high, we need to be careful, potentially putting our stop losses pretty tight. So if it does go for that upper tail extension, we're out of that trade pretty quickly and we're not giving up too much money. Now, the same thing could be said for the lowercase b. It is identical, right? All we're doing is we are shifting where the value high and the value low is. So the sellers pushed you down, and then they found all this value here. So the lowercase b has a slight bearish bias, but not an overly bearish bias. Okay? So we can be a seller around the value area high looking for our playbook patterns. We can be a seller around the value area low looking for those breakout trades or those rebound trades. We could also be a buyer around the value area low, but once again, you need to be careful because you are counter trading the prevailing trend. Okay? There's a slight bearish bias, you are counter trading that. So be careful. You can look for those rotations by being a buyer down here. Just be careful. Don't risk too much. Okay? Now, when we are selling that value area high, we can look for that lower tail extension. So we can take that upper tail, whether it's 20 points, 50 points, whatever. We can draw that down on the lower tail, and that becomes our target. All right? Or we can target anything else, value areas, VWAPs, whatever. Same thing. You look for that potential rebound. You look for where that value is being accepted and is it being protected. Always remind yourself of those two things. Are we finding value outside the value area? And is it being protected? Okay, now that we know how to properly trade a capital P and a lowercase b, what happens if they are not being respected? What happens if that value low of a capital P or the value high of a cap or lowercase b, excuse me, is being rejected. How do we trade those? That is what I call a P-shape failure or a lowercase b failure. Because they should have this slight bias. The bias should be pushing them in one direction, but it's not. It's failing to do so. So what happens is they begin to sell the value area low by finding value below that value area and protecting it. Remember those two things, finding value and protecting it. They find value below the value low. The sellers are strong, right? And the sellers are protecting that value bearishly. So what are they looking for? Well, if we remember what a P shape is showing you, it is showing you that this is a very weak value, very low value tail, and most of our value is on this value high, right? This value area towards the high. So if we fail this, it should be quite easy to retrace this lower tail because there's basically no value there to act as support. This is known as a tail squeeze, right? We are squeezing out that lower tail. The sellers are coming in and pushing you all the way back down to the low of day. This is very common in like a downtrend because we could have a downtrend happening. Then we could see a P shape, but the P shape doesn't hold. Remember, it's not an overly bullish day. It's just a kind of bullish day. So if it's happening in a downtrend, the sellers could come right back in, lose that value low, and then you start to go for that lower tail. So we would trade that the same way, right? We could look for our sell trades, our rebound trades, when you're finding that value outside the value area. Our stop loss could be above the value area low, or if we could get the really good risk to reward, we could put it above VWAP or above the POC, and we could also put it above the value area high. It really just depends on how wide it is. Sometimes that value area is 10 points wide, 20 points wide. It could get ridiculous sometimes, okay? So you have to measure it based on your risk to reward. If I'm targeting the low of the tail, and that's offering me 20 points, then my stop loss could go above VWAP and give me a 2-to-1, right? Same thing with a capital B, or sorry, a lowercase b, excuse me. Remember, you're just flipping the value area, right? So if we're finding value above that value high, think about if we're like ranging, then we start to bounce, and we range a little bit, and we start to push up. So we're finding all this value above that value area high, and we're accepting it. We are protecting it, right? So we could be a buyer up here, stop loss below that value high, or below the POC or VWAP, or below the value low. It's all based on your risk to reward if you're targeting that entire tail to be squeezed. Okay? They are all very important levels, so putting your stop loss below them is all good, right? Some will just give you a little bit more protection based on where that value is. All right? So remember those two things when you are creating an imbalance or when you're going against an imbalance, when you're breaking out of that value area. Are we building value, and are we protecting that value? Is the buyer-sell pressure protecting that node in a way that it shouldn't be, right? If it's just ranging back and forth, then it stops ranging and it starts pushing up. They were supposed to go down, now they're not. Always look for those two things when you're going from a ranging balance into more of a trend. All right, let's talk about a capital B. Now, these days are a bit more difficult because we don't know whether they are bullish bias or bearish bias. It really depends on how the price is moving on that day. Did the first node happen on the high, or did the second node happen on the high? We don't know, right? We need to figure out where the nodes built up first, start with where the day started, right, and see how it developed throughout the day. Then we need to see who is protecting the middle. Okay. So these days you can trade kind of two different ways. You can trade them like D shapes, where you're going for those rotations around the nodes. So either rotating the lower node, rotating the upper node, whatever, right? You're just looking for those back and forth rotations if it's a very choppy day. Or you can look for trades in that middle LVN zone. So think about if we're ranging, we're just chopping around, then we come down, we hit that LVN, and then we start to bounce aggressively. Now, some of our favorite trades are like sweep trades. They are trades that are very aggressive reversals. So think about that aggressive reversal happening in that middle of that capital B. It's a prime area to trade that reversal, right? So if you see that reversal in that middle section of a capital B, then you can go for a trade, right? You could use that lower node as kind of a stop loss, and you could target the rotation of the upper node. And it doesn't matter if the value area high and the value area low is on the upper node or if it's on the lower node. It matters whichever node is the node that's happening right now, right? The node that's in control right now. Another way you could trade this is looking for single print fill-ins, which we'll talk about here in a second with the market profile examples. So with market profile, we have what's known as single prints, where you're moving very aggressively in one direction and you create single prints in that area that you are moving very aggressively through, typically where they line up with LVNs. Now, a lot of the times during a capital B, you will have single prints in the middle of that capital B. So another way you could trade them is if you're being a seller around that upper node, kind of around that where that value high is on that upper node, and you could target not only the rotation of that upper node, but also the single prints in the middle of that capital B. It's a single print fill-in trade, right? So it gives you a very good target. Single prints are not a very good entry. They're typically a better target. But that's one way you could trade these capital Bs. So you could trade the extremes of the nodes looking for that LVN as a magnet, kind of pulling price back into us, right? It has to go through the LVN to get to the other high volume node, right? So they're kind of acting like a magnet. Or you could trade them like a single print fill-in. All right. Last but not least is the thin profile. Typically, this profile is formed when you're moving aggressively in one direction, either to the upside or the downside. How do we trade these days? These days, I would ignore the value area, right? Because the value area doesn't really mean a whole lot. Because you don't have one definitive value area node. You have a bunch of smaller nodes. So I would be more focused on the other indicators like the EMAs, VWAP, all that stuff. Your trending indicators, right? Watching the 24 EMA, the OTS trail, etc., etc. Watch out for if it's a vertical distribution or a downward accumulation, which is the opposite of a vertical distribution, right? And what you're looking for in terms of volume profile is those two things we talked about earlier. Are we finding value away from these other nodes? And are we protecting that value? Okay. So think about if we're trending very aggressively in one direction to the upside, we are going to be continuously doing those two things. We're going to find value. We're going to protect it. We're going to go up. We're going to find value again. We're going to protect it. We're going to go up. Rinse and repeat. Are we finding value? And are we protecting that value? So what happens when that no longer is the case? What happens when one of those two things is breaking? We are no longer finding higher value. or we are no longer protecting higher value. What happens when we start using these nodes not as support? Think about levels, right? Support levels below. What happens if we start using them as resistance? So think about if we were pushing up and we had all these nodes acting as support below us, but now we started to use that highest node as resistance. Maybe it was sweeping that node. Maybe it was a rollover top on that node. What happens if we did it again? So now we have two nodes above us. That would be indicating that you are no longer doing your two things. You are no longer finding higher value. You are no longer protecting that higher value. You are shifting into more of a value retrace, where you're going back into old value. You're retracing these prior nodes. You're finding old value. You're going back to respecting old value. So that is where we can look for very strong reversal trades, because we were doing one thing. The one thing was finding higher value and protecting it. Now we're doing another thing. We are not doing that. We are respecting this value bearishly. We are going against that prevailing trend. Okay, so you can look for when those nodes are continuously being protected and following the prevailing trend, or now are we starting to flip those nodes into the counter trend. And what I like to say is the two highest nodes or the two lowest nodes. Once you lose two major nodes, that's when that reversal starts to happen. Okay. So once you lose your two highest nodes on the day, start to look for those potential reversals, or vice versa. All right, guys, I know this is going to be a very long video. We're already like over an hour into it, and we still have a lot to discuss. We're going to get into breaking the profiles down. We're going to get into market profile, and we're going to get into some more examples of some types of trades that you can get into. Now, this will obviously be probably the longest video in this series, because this is my specialty, right? This is what I focus on. Volume profile is my cornerstone, right? It's the number one thing that I use in my trading. So thank you guys for sticking with me. If you guys enjoyed this video, hit the like button, be sure to subscribe, and let's get into breaking these profiles down based on the sessions or based on different times of day. So a couple ways you can break these profiles down is you can break them down based on like your full session and your morning session. So kind of like this chart here, where I have my blue profile for the pre-market hours, and I have my gray profile for the full session, so taking into account the entire day. We could also break it down based on the morning profile, starting from like 9:30 to 12 o'clock Eastern, and then going into the afternoon, so everything past 12 o'clock into the close. There are many ways you can break these profiles up, right? So I'm going to show you a couple of ways that I like to do it. One of the main ways I like to do it is right here. I'll show you the settings for these, by the way, if you guys want to copy these on TradingView. This would be my afternoon profile settings, and this would be my morning profile settings. If you're trading in the afternoon, this is a very strong way to use volume profile, because we can see where that value is shifting from the morning to the afternoon. So we can look for those afternoon reversals. We can look for those two things that I just talked about. Are we finding value outside of the morning profile? Are we accepting that value, or are we rejecting it and going back into the morning value, which, by the way, is one of the strongest patterns we have seen in a very long time? Is think about where all that morning value is. When we are trying to trade outside of that morning value, either to the upside or downside, it is extremely common that we pull back into that morning value. And I'm not talking about the value high or value low or POC. I don't care about any of that stuff when it comes to this breakdown. I just care about where the value is trading. So basically take the low of day and high of day in that morning profile, and that is what I would call the morning value. So when we're finding value in the afternoon outside of that, it is extremely likely that that afternoon value will not be respected, and we will pull back into that morning value, either the same day right into the close, maybe a closing reversal, or if it's not respected the same day, it will come back the following day. And I'm not going to cherry pick examples because this literally happens almost every single day. I'll just scroll through this and you guys can see exactly what I mean. Just look at the price action. It is pulling back into that morning value, either the same day or the following day. This example right here would be the following day, right? And it does it time and time and time again. The probability, I don't know the exact number, but it's extremely high. I would say it's probably over 70 or 80% of the time. When we are finding that afternoon value, it is not being respected. So you're asking yourself, okay, now that we know that, how can we use that in our trading? Once again, it is not a trade in the way that I'm going to be like, hey, I'm going to press the button because of this. It is waking me up to pay attention, to take trades, to look for my trades. So if I see a very large afternoon breakout that is outside of our morning value, and we start to see that reversal, right? We start to see the sweeps or the blue pivot combos, whatever, right? Then I'm going to have that better feeling for my trade saying, hey, there's a high chance that it wants to go back to that morning value. So my trade looks pretty good here. That reversal trade has a little bit more of a bonus. The strike rate is a little bit higher because of this afternoon value not being respected. Okay, so it's not a reason to press the button. It's just a very good bonus for those reversal trades that you find in the afternoon. And you are targeting that morning value, pulling back to that morning high or that morning low. Okay. Another way that I like to break down these profiles is every single day on my live streams. You can literally go back to every single live stream. The very first thing that I do in the morning is we develop a trade plan. And we take a look at the day shape based on all of the hours leading up to the open. So the open starts at 9:30 a.m. Eastern time for me. So that would go from 6 p.m. Eastern all the way to 9:30 Eastern. And let me show you my settings really quick if you guys want to copy these. So this is my morning profile leading up to the open. So basically the after hours profile. And this is the full session profile. So leading into the open, we can take a look at the blue profile, which is the overnight profile, and say, okay, it is this shape. It is a D shape, or it is a P shape, or a lowercase b, or whatever. And based on that long analysis that I just told you guys about how to determine your bias on those shapes and what trades we are looking for based on those shapes, that is exactly what we do. We say, okay, it's a D shape. What does that mean? Well, a D shape is neutral. It means we want to be looking for rotations, or we want to look for those two things that I talked about. Are we breaking out of the value area and generating value above it or below it? And are we protecting that value? Then we can look for an expansion into a capital P or a lowercase b or a trend profile, whatever. But at the time, what shape are we? What is our bias at this current time? That is how we build our trade plan, based on that pre-market profile. If it's a D shape, we have a neutral bias. If it's a P shape, we have a small bullish bias. Lowercase b, small bearish bias. Capital B, well, that's a little bit harder. Let's determine where that secondary node is. Let's determine how the middle is being respected, etc. If it's a trend profile, which way are we trending? All right. So we take a look at that morning profile, that pre-market profile, and we base our bias and our trade plan off of that. Okay? So that's another way that I like to break it down. Another thing you can do is when you are using market profile. What is market profile? Market profile is basically the exact same thing as volume profile in terms of shape, in terms of value area, in terms of value high, value low, POC, all that stuff. It's pretty much exactly the same. A couple things it differs in is you can use market profile to find fancy things known as poor highs, poor lows, single prints. You could also use it for the initial balance, which you can find in volume profile as well, but it is typically a market profile term. And also something known as one time framing. So we're looking at a market profile right now, and you guys are probably like, what the hell am I looking at? So a market profile is a volume profile, but it takes into account time. So every letter, A, B, C, D, whatever, right? Those are 30-minute sessions, typically 30-minute sessions. Some people use weird sessions, but very, very often it is a 30-minute session. And you guys can read about it in the books. That comes from the floor traders way back in the day. The sessions they used to write down on their time cards, their trade cards. So every letter, think about it as a 30-minute candle. This whole section of the letter A is just a 30-minute candle. That is the 30-minute high. That is the 30-minute low. It doesn't exactly tell you where the open or close is. You can make it do that. That's a little bit complicated. But it tells you where the high of that session is, where the session was trading, and where is the low of that session. So the B session would be the session after that. So A would be from 9:30 to 10 o'clock. The B session would be from 10 o'clock to 10:30, so on and so forth. And they line up together like a volume profile. So they overlap, right? They build those nodes. You'll hear people call them TPOs, time price opportunity, right? Basically, a TPO is a single letter. So that single box, that single A, that is a TPO. If you guys want to see my settings, here are my settings. The TPO setting on TradingView is the ticks per row setting. So every letter that I have on my market profile is 8 ticks. If you guys are ES traders, that's 2 points. There's 4 ticks in a point. And I use a 70 value area, but I don't really care about the value area, so it doesn't matter. Okay, so we look at it like a volume profile, but instead of just being a profile, instead of being a cluster of volume, it is broken down into 30-minute sessions. Now, because it is broken down, it can give us some fancy signals. Those fancy signals are poor highs and poor lows and single prints. What is a poor high? What is a poor low? Well, a proper tail, when you're looking at a market profile, is when you have one TPO session. So a session of TPOs, like the A session, the B session, whatever it may be. The tail on the lower portion of the day or the upper portion of the day only consists of one letter. That is a proper tail. So this tail only consists of the A letter, the A session. We know that is the tail because where it starts to overlap with more than one letter is right here. You see how it goes from only the letter A to the letter A and B? That means the A and B session was overlapping on top of each other right here. But on this lower portion right here, that was only the A session. Therefore, it is a tail. It is the lower tail. That is a proper tail. If it is not a proper tail and it's overlapping with multiple sessions, look at this J and M here, that is a poor high because it has overlapping letters. It has overlapping TPOs. Once again, a proper tail, only one letter. For example, the C session right here, the B session right here, the H session right here. It's all one section, one session of one letter. But when it's overlapping with multiple TPOs, like this one right here, the K and L session, that is a poor level. It is a poor high or a poor low. It's basically when a double top or a double bottom happened. And you're asking yourself, okay, why does that matter? It matters because they are typically retested. They are typically levels that are not proper. They should not have happened that way. A proper tail is one letter. It has the same letter on that upper tail and lower tail. Okay? So if it's not proper, the market wants to make it proper by retesting it either the same day or the following day. So they can be used as targets. They're not a reason to enter a trade, but they are a target if you're in a trade. Let's just say, for example, we're in some kind of trade here. It doesn't matter what kind of trade. Let's just say we found a trade here and we're a buyer. And we're like, okay, what do I target? Well, I can target high of day because it's a poor high. And poor highs are likely to be retested. So therefore, that can be my target with a high probability. All right. Another thing a market profile can give you is what's known as a single print. They are highlighted yellow on my chart. A single print is when you have only one TPO from that session at a price. That is not an upper tail or lower tail. Upper tails and lower tails cannot, let me emphasize this because I get asked this question quite a lot on stream. Yes, this whole lower tail of A's are single TPOs, right? They don't have a second TPO overlapping them, but they cannot be single prints because they are a tail. A proper single print is inside of the day. It is not the upper tail. It is not the lower tail. Yes, you can argue they are like technically a single print where they are a single letter, but they are not traded as a single print would be traded. The proper single prints are during the inside of the day. They have multiple TPOs above them and multiple TPOs below them. Okay? So notice how this is a single TPO that has multiple TPOs above it, matching TPOs, and it has multiple TPOs below it, matching TPOs below it as well. Let's take that same thing on the bottom tail here. It has a single letter. It has multiple TPOs matching above it, but it does not have multiple matching TPOs below it. Therefore, it is not a proper single print. A single print must have matching multiple TPOs above it and below it, and it has to be a single letter inside of it. Okay, it's kind of like a sandwich, right? So how do we trade single prints? Okay, now we know what a single print is. How do we trade it? Very important. Single prints are not a reason to press the button. They are not a reason to say, oh, there's single prints there, I'm buying. Oh, there's single prints there, I'm selling. No, that's not how it works. They are a very good target because they like to be filled in. It's the same with the gap theory. When price gaps above something or gaps below it and creates this large open gap, it likes to be filled in. Same thing with single prints. Single prints like to be filled in. So we can take that into our trading. Let's say For example, we're selling this high of day for some reason. Maybe there's a sweep up there, whatever. And we know, hey, there are single prints below us. Therefore, I can use that single print as a valid target because there is a high probability that that single print will be filled in. Let's take this, for example, here. There is a very large section of single prints right here, and look at price getting pulled back into it. You have all this price trading down here, but look at price. It pulls back into it and fills in a couple of those single prints. It pulls back into it, fills in those single prints to the exact tick. To the exact tick. We see that time and time again. These are very strong magnets. Very, very strong. They will be filled in the same way gaps like to be filled in. Okay? The other thing we can look at is what's known as an initial balance. The initial balance is typically the A and B session, the first hour of the day. You can do initial balance a couple ways. You can take the A and B session combined, look for the highest point and the lowest point. It's this, you see the white bar right here? This white bar is the initial balance. It's the highest point during the A and B session and the lowest point. You could go a little bit further if you want, and you can take the value high and the value low of the first hour of the day. I think both are fine. More valid is just taking the high and low. I think more people do that. What does the initial balance tell you? Well, once again, it's not a trade. It's not like, hey, the initial balance here, buy, sell. It's not like that. Now, there are many trading techniques that do use that. I do not use that, so I'm not going to talk about it a lot. If you guys want to learn more about that, just look up initial balance trades. I'm sure there are plenty of videos out there. What I use it for is kind of a bias. A pattern that we have seen recently, and it's on my chart right now, is when one side of the initial balance is taken out, the other side of that initial balance is very likely to not be tested. For example, here's the initial balance high, or sorry, the low, and here's the high. The low was taken out. We can tell because all the TPOs below it. The high was not tested. Same thing here. Low, the high was taken out. The low was not tested. Here's the low. Here's the high. The high was taken out. The low was not tested. This happens time and time and time again. When one side of the initial balance is taken out, the other side is unlikely to be taken out. The only exception is if the initial balance is extremely small. If it's only like 5 or 10 points, right? If it's a very small initial balance, it can be taken out in both directions. But if it's a pretty wide initial balance, and what do I mean by small and wide? It's really hard to say. It's based on volatility. You have to look at the current volatility. Okay. So with a standard volatility, one side is taken out, the other side is not. So you can use that however you please. If you're a swing trader, you can use it for stop losses. You can use it for momentum if you see the breakouts of one side of the initial balance, etc., etc. It's not an exact reason to press the button. It's just providing that bonus to your bias. Another thing you can do with initial balance, I know guys, once again, I'm sorry, this video is very long. I apologize. Stick with me. Another thing you can do with initial balance is initial balance extensions. I talked about tail extensions earlier. Same exact theory, but with the initial balance. So you can measure the initial balance, and you can say, hey, we're breaking out one side of the initial balance. We're very one-directional. We're unlikely to test the other side of the initial balance. What can we target? Let's say we're high of day and there's just nothing above us. Or sorry, let's say we're all-time high and there's nothing above us. There's no value. There's no anything. We're all-time high. There's nothing above us. We can take that initial balance and we can measure it and say, here's a 100% extension, here's a 200% extension, here's a 300% extension, however far we want to take it. Okay? So an easy way to do that is you just measure it out and you extend it. That's 100%. Okay, then you take another one. That's 200%, so on and so forth. In a strong trending day, you will typically get 100%. For example, look at this day right here. If you measure the initial balance, and we had that breakout, maybe it's an afternoon breakout, whatever it may be, there's that 100%. I think you even got 200%. Yeah, there's your 200%. So a very strong trend, maybe you'll get 200%. Now, you're normally not going to go 300. 300 is very, very extreme. I'd say 100% is common. 200%, yes, you could achieve it if it's very trendy. 300%, probably not going to happen. Unless the initial balance was very, very small. Okay, finally, the last thing you can look for on market profile is what's known as one time framing. And you can look at this on just a standard 30-minute chart as well. And you guys have heard me talk about this many times throughout this series already. One time framing is, remember, when we're looking at a market profile, we are broken down into 30-minute sessions. The A session, the first 30 minutes. The B session, the second 30 minutes. So on and so forth. So it originated from when the sessions are breaking one directionally. You're breaking the high of the A session with the B session. The C session is breaking the high of the B session, and so on and so forth. But it is not breaking, it is not testing the low of that session. It is very one directional. One extreme of the session is continuously being broken, while the other extreme is not being broken. That can be bearish or that can be bullish. You are one time framing. You are one directionally moving. Okay? How we use that in our trading. Once again, it is not a reason to trade. It's not a reason to press the buy or sell button. It's just there for confluence. We talked about confluence a lot in our indicators video. Okay? It's just there to provide value. It's there to provide a bonus to your trade. So you see a playbook trade and you're like, hey, we're one time framing. My trade's looking really good. I can just trail these 30-minute lows and we're going to continue to one time frame higher and I'm going to continue to make profit, right? So it benefits your trade. It doesn't make you trade. Now there is an exception. There is one method in one time framing that is kind of a trade. It's known as halfbacks. Think about a session looking like this, and we are one time frame. We're pushing constantly above it. What we can do is we can measure the 50% of that candle, the halfback of that candle, the halfway point. And if we are trying to get into that aggressive trend, we can look to be a trader around the halfway point of that prior candle. And our stop loss could be below the prior candle extreme. Because what is one time framing? One time framing is pushing very one directionally. They are not testing the lows of those candles. So therefore, I can put my stop loss and trail my stop loss on the lows of those candles. Because if that breaks, the one time framing is invalidated. Therefore, my trade is invalidated. Okay? Now, I don't trade halfbacks by themselves, but I am mindful of where they are. I am so mindful of it, in fact, I created an indicator to do this. And you guys can find the indicator on TradingView for free. It's completely free. If you type in halfback and one time framing, you should be able to find it. It's by Oasis Trading. It's an indicator that will mark out the halfback with a line, and it will tell you when you're one time framing bullishly with a blue triangle or bearishly with a orange triangle. I believe those are the default settings. If not, you can change the colors on your own. But if you guys want some help seeing that in effect, look for that indicator. It's completely free. Just type in halfback and one time framing, and it should come up. Okay, so that covered market profile. So finally, we're just going to go through and quickly look at some different types of trades: value retraces, overnight fades, rotations, etc. I'm not going to cherry pick a bunch of these trade examples because these are things that we do literally every single live stream. We talk about these trades, we talk about these biases and how we are going to trade these days. So if you guys want to see more examples of this, just stop by the live stream. Like I said, this is my cornerstone of my trading. We do this literally every single day. So I'm just going to quickly run through these different shapes and show you kind of some examples of how to see the shape and how we could have traded it. Okay, so this obviously is a D-shaped profile. You see it's a bell curve. It's very two-directional, very back and forth. So we would have wanted to be a buyer around that value low and a seller around that value high. Stop loss above the high, above the upper tail. Or if we're a buyer, stop loss below the lower tail. This is a P-shaped profile, so if that was forming during the day, obviously we're looking at this, guys, in hindsight. We are looking at this after the fact. So if I wanted to do this in a more sophisticated way, I could go through a bar replay system, or I could use like a developing profile, and I could walk you guys through how that profile is developing. This is already almost a 2-hour long video, so I'm not going to do that in this video. If you guys want to see that, come by the live stream or watch my other volume profile videos. By the way, I have numerous volume profile videos on my channel, so if you guys enjoy this type of trading, be sure to check those out. So this would be a P-shaped profile. So if we saw this profile forming throughout the day, we would want to be a buyer around the value low and a seller around the value high, potentially looking for a breakout and an upper tail extension. Okay. This would be a value retrace. So we had a closed profile the prior day. Let's pretend like, we don't have to pretend actually, this is what happened. So the start of the day started around here. So we found a lot of value. We were trading below that value area. And then we retraced back into that value low. So as we started finding value back inside that prior value, we could look for a retrace trade going back into that value high or that POC. So starting here, we could have a bullish bias, stop loss below, looking for that retrace into that value high. Let's imagine on this day here, we have that value building below us, and we have a very obvious value retrace back to the downside. Okay, so we started losing where that value high would be, and I can show you this if I just pull a developing profile. Once we started to lose that value high, this became a value retrace trade looking for that value low. So we look for our playbook trades. Maybe it was an afternoon reversal. Remember I talked about how that morning value is respected and that afternoon value is not respected. Maybe this was an afternoon reversal. We're going to look for that morning value to be tested. So we took some type of short up here, and then boom, we got that value retrace back into that value low. Reminder, guys, I keep saying this. The volume profile itself is not telling you, hey, buy, hey, sell here, buy here. It's giving us a guide. It is giving us a bias. It's giving us levels that we can use in our trades from our playbook. Okay. Let's look at some more. This day here, we can tell was a D-shaped failure because look at how price was trading. Very back and forth, right? Then we had a very strong breakdown to the downside. So this would be a D-shaped failure. I wouldn't call this a capital B at the start of the day, but obviously it could be a capital B or a trend profile towards the end of the day. It started out as a D shape, then we lost it, and then generated that lower tail. Okay? And sorry guys, I'm losing my voice. This video is quite long. Right here we have an example of a capital B failure. So remember we said earlier today, the capital B is typically bearish bias, but not always, right? It means the bears are in control right now, but they're not overly in control. So once we started to lose that value high and find a lot of value above that value high, what do we look for? We look for that tail to be retested. So you see how price went all the way back and retested that upper tail? So we could have been a breakout buyer once we found value above that value high, looking for that upper tail squeeze. Let's quickly go through a few more, and then I'll close it up by showing you guys how we find our levels with volume profile. Okay, this one here, if we think about the start of this day here, look at the prior day. The prior day was a capital B. You had a strong node here, a strong node here, and then kind of an LVN in between. Not a lot of volume in between. What did we say earlier? It's extremely important to figure out where is the secondary node. So we have the first node here, the secondary node here, so that would be bearish, right? Value is shifting to the downside. But what's the other very important thing we want to look for? We want to see who controls the middle of the day. How is price reacting to the middle of the day? What do we see here? Price is hitting the middle, sell. Hitting the middle, sell. Therefore, the bears are controlling that capital B. So we have a bearish bias moving forward from this point on. They were not finding value above that middle zone. Here's an example of a lowercase b tail extension. So remember earlier we said lowercase b, you can take that upper tail, extend it to the lower tail. And let me clarify this. Why is that happening? The market goes through balance and imbalance, right? So we have balance and we have imbalance, whether it be a trend profile or what, right? Doesn't matter. So we're going from an imbalance, we have that lowercase b imbalance, and then we're pushing that lower tail. So what does the day look like now? So if we have a lowercase b, and then we extend that lower tail, it looks like a D shape now, doesn't it? Most our volume and value is towards the middle. We're falling off towards the high. We're falling off towards the low. Now, obviously, that could shift, but it's going from an imbalance into a balance. Now, I'm not going to get into that. I recommend reading Mind Over Markets to get more into the auction market theory. But that's basically what's happening. We are going from balance to imbalance back to balance. Okay, so we have a lowercase b here, and then boom, we extend that lower tail. Look at that. So if I were to measure the upper tail here, and I extend it downward, we have that extension. All right. Same thing with this P shape here, it just does it with a gap. So take the lower tail, and then we obviously extended it, but it did it with a gap. All right. Okay, we're almost done, guys. Last thing. Now, I don't really have a video on this because, once again, I do this literally every single live stream. At the start of every live stream, we find all of our levels, and we build a trade plan based on those levels. So how do I find those levels? All we do is we look at the full session of the prior volume profiles, and we mark out the value low, the value high. Sometimes we mark out the high of day and low of day as well. But most often, we mark out the value high and the value low, and sometimes the POC. Most of the time, we want to be looking for untested, they're also known as naked levels. So naked value high, naked value low, naked POC, it just means they're untested. Now, if they are tested during a pre-market, so for example, you see this pre-market right here is testing that value high, that doesn't count for me. I want to see a cash hour. Cash is during the actual hours, 9:30 to 4 p.m. I want to see a cash retest of that level. Then I consider it tested. Okay, for example, look at this level right here that I deleted. This was a level, but it was tested during the cash hours, so I deleted it. It's no longer naked. Okay? So I just continuously do this every single day. And my chart looks ridiculous, by the way, because look at how many levels I have. I do this every single day, and if they're not tested, I don't delete them. Because we'll come back to these levels like months in the future sometimes, and it will bounce right off of them to the exact tick. If you don't believe me, like I said, just come by and watch the live stream. I'm like a soundboard on my live stream because I say the same thing so many times over and over again. And one of the things I say is damn near to the tick, because these levels get tested damn near to the tick over and over and over again. So that's why I leave these on my chart. And funny enough, look at this level here. It says extension, right? EXT, because I mark out those tail extensions as well. Okay? So we could look for incomplete auctions. We could look for value highs, value lows, POCs, high a day, low a day, extensions, whatever. So many levels we could look for. And once they are tested during a cash profile, I take them off. Okay, guys, I know this was a long one. I appreciate you sticking it to the end if you did. On our next and final video in this series, we will be covering order flow. We're going to go more in depth into delta, into footprint, into absorption, exhaustion, tape reading, block trades. And what this video is really going to focus on is I constantly talk about protecting levels, respecting levels. Especially in today's video, I talked a lot about building a node, respecting that node. How do we know if that buy or sell pressure is respecting the node? Order flow is how we know. So we're going to talk about that in the next video. All right. Finally, if you guys want to get involved in the giveaway, just remember to follow what's on your screen here. Be subscribed to the YouTube channel. Be actively using our Apex code BREW, which, by the way, is 80% off right now. Comment on these videos down below. And please, for your comment, have a question for our Q&A stream. If you really can't think of a question, then you can put any other comment. But questions do help a lot for our Q&A stream. You can provide your receipts from Apex. If you're a Discord member, you can provide your receipt or your Discord username, and you can take screenshots of your comments and have them sent to my email down below. But all right, guys, once again, thank you so much for sticking it out. I will see you guys in our next one and our final video to close up the series. Peace out, guys.